Welcome to another insightful episode of Financial Insights in Minutes. We summarize the day's crucial financial videos to save you time. Today, we're exploring some pressing questions. Is the stock market on the verge of a crash? Join us as we analyze the Fed's losses and what it means for the economy.
We'll also delve into the housing market's shocking changes that every seller should know. Don't miss our expert insights on the cryptocurrency impact in today's market.
In this episode, we'll condense essential financial knowledge you need now. First, Steve Hanke discusses the Fed's staggering financial losses and the risks of a market crash. Next, Jeff Snyder analyzes why the economy is in a goods recession and the impact on consumer demand. Melody Wright shares alarming trends in the housing market and the rise of motivated sellers. Matt talks about upcoming earnings that could shake the stock market and labor indicators shaping volatility. Mike examines key economic announcements and their potential to create a volatile trading week. Melissa Kearney warns of a population collapse threatening our economy and future growth. Welcome to David Lin's channel on YouTube. Today we're diving into a staggering topic, the Federal Reserve's helicopter drop insight. And guess what? They're losing a cool $100 billion a year. Today's guest is the astute Steve Hanke, a leading expert in inflation and monetary policy.
Absolutely. With an extensive background as a professor, Steve Hanke provides clarity on what's going wrong at the Fed and its implications for our economy. Let's strap in for some fascinating insights.
So, what's the main thesis of Steve Hanke's argument?
Hanke argues that the Fed's staggering losses, about $100 billion this year, are a signal of deeper economic troubles. He suggests this situation could lead the U.S. towards financial instability and unsustainable debt levels.
What are the shocking numbers Hanke presents?
He emphasizes that the U.S. debt-to-GDP ratio has crossed the 100% mark, which many experts, including Hanke, believe is unsustainable in the long run.
Interesting. What's happening with inflation and money supply?
Hanke points out that the money supply has actually contracted since July 2022, leading to lower inflation rates, which he sees as a positive development.
What about the Fed's financial health?
The Fed can face significant losses without going bankrupt in the traditional sense. Their ability to print money means insolvency is not a concern, but it does affect their profit transfers to government accounts.
What are Hanke's predictions going forward?
He predicts that without Fed profits to supplement government funds, we may see an increase in national deficits. This could lead to raised taxes or radically trimmed government spending.
Is inflation really out of sight then?
Hanke sees disinflation continuing, but underlying concerns remain, with inflation rates likely stabilizing between 2.5% to 3% by the end of this year.
To wrap things up, what should viewers take away from Hanke's insights?
Hanke emphasizes that the U.S. needs to brace for potential fiscal challenges stemming from the Fed's losses. It's critical to develop robust economic policies to address these emerging issues and stabilize our financial future.
And what final advice does Hanke give regarding economic policy?
He urges a close reevaluation of fiscal policies and stresses that immediate strategic reforms are essential to avoid deeper financial crises down the road.
Welcome to Eurodollar University. Today's topic is a deep dive into the economic realities that are reshaping our landscape. The expert today is Jeff Snyder, co-founder of Eurodollar University. His insights have stood the test of time, cutting through the noise of economic chatter.
That's right. Jeff's knowledge of monetary trends offers a valuable perspective on the current downturn in various industries and the overall economy.
What is the main thesis of Jeff's latest observations?
The core thesis suggests that the economy is firmly in a goods recession. This is underscored by recent GDP numbers, intertwined with corporate warnings from major players, indicating that this downturn is both broad and significant.
Let's discuss the key points, starting with GDP and corporate warnings. What's the latest?
Recent GDP reports show a fading soft landing as many corporations, including giants like Nestle and Unilever, express growing concerns about their sales and earnings.
And what's happening in the commodity markets?
Commodity markets are experiencing significant declines, especially in crude oil prices, which have dropped below $77 per barrel. The automotive industry's inventory is also soaring as sales stagnate.
How about consumer demand?
Consumers are feeling the financial strain, leading to a reduction in spending. Retail inventories are historically high, hinting at deteriorating demand.
Any insights on how major brands are handling these changes?
Definitely. Nestle recently downgraded its sales growth projections, while Unilever managed to adapt better by focusing on volume growth, showcasing contrasting strategies amidst the downturn.
What predictions does Jeff make about the economic landscape?
He predicts further economic weakness, with declining consumer demand likely to pressure both employment levels and corporate revenues significantly.
What are the takes on inflation?
Jeff notes that inflation pressures are transitioning into falling prices, and understanding inflation is more complex than the simple narrative often presented.
So what should viewers take away from this discussion?
The main takeaway is the critical need to understand economic trends, as the goods recession shapes the financial landscape. Awareness can lead to better decisions as we navigate through these turbulent times.
And what's the final note on Eurodollar University?
Eurodollar University provides the insights necessary to make sense of the financial shifts happening right now. It's the perfect resource for anyone looking to stay informed.
Welcome to Thoughtful Money's YouTube channel. Today's topic dives into the housing market's current state and the surprising shifts underway. Joining us is Melody Wright, an insightful housing analyst, ready to unpack the latest stats and trends.
Absolutely. Melody brings over a decade of experience in analyzing housing trends, and she's had a front-row seat to the evolving dynamics of this market. Get ready for some eye-opening insights.
So, Melody is suggesting that the housing market is shifting dramatically. What's her main thesis here?
The core thesis is clear. The housing market has reached a critical inflection point. With rising delinquencies and inventory up nearly 30% year over year, motivated sellers are starting to emerge across the country.
Let's break down some key points from Melody's discussion. What's happening with transactions?
Right now, we're seeing the lowest transactions during what typically is a busy season. This is coupled with a staggering increase in inventory, nearly 30% year over year.
And how about those delinquency rates Melody mentioned?
Well, there has been a shocking 19% monthly increase in 30-plus day delinquencies. This alarming trend brings back memories of the 2008 financial crisis.
What about the emotional aspects for homeowners?
Homeowners are facing rising insurance and tax bills, with some experiencing payment increases of $600 to even over $1,000. Many are realizing they can no longer afford their homes, becoming motivated sellers as a result.
So is this trend limited to specific areas?
Not at all. While Florida and Texas are certainly experiencing these trends, there's a nationwide shift occurring where many markets are cooling off and price declines are being observed.
Based on Melody's insights, what predictions can be made about future trends?
There are growing concerns that these increasing delinquency rates could lead to a wave of foreclosures. If current trends continue, we might be facing a national housing crisis.
What about the role of institutional sellers?
As institutional sellers start to feel pressure, there's a real risk of them flooding the market with properties at lower prices, further driving down the values. Definitely something worth watching.
Wrapping it all up, what are the overall takeaways?
The situation is, though, tense. Increasing delinquencies coupled with rising inventory suggest an urgent need for both buyers and sellers to reassess their strategies in this market. Vigilance will be key.
Welcome to Trade Brigade. Are you ready for an unprecedented week of trading? With major companies like AMD, Microsoft, and Amazon reporting earnings, this week promises to be anything but ordinary.
That's right. The trading landscape is shifting. And with Matt as our guide, we're in for an informative journey. His expertise in market analysis brings a lot to the table.
What's the main thesis behind this week's insights?
The central idea is that the upcoming earnings reports from tech giants and key labor market indicators could lead to significant market volatility. Understanding these factors will be essential for traders.
Let's break it down, starting with those lucrative earnings reports.
Absolutely. Companies like AMD, Microsoft, and Amazon are not just big names. Their performance impacts the entire market, especially the semiconductor sector.
What about the economic reports? What should traders look out for?
This week, traders should keep an eye on labor market updates like unemployment rates and non-farm payrolls, crucial indicators that can sway market sentiment.
And how about the Fed's upcoming announcements?
That's a hot topic. With Jerome Powell speaking, any hints about potential rate cuts could significantly influence market movements.
So, what's happening with the S&P 500 trends?
The S&P 500 is currently on an uptrend, and if it maintains its key levels, we might see continued higher lows, which is a positive sign.
What's the takeaway regarding market volatility this week?
With all these catalysts, volatility is a certainty. Managing risk and setting proper expectations will be crucial for traders navigating this turbulent week.
What predictions are on the table for this week?
If unemployment rates tick up, we might see rate cuts sooner than expected. The market is hypersensitive to any signals from the Fed this week.
And regarding earnings impact on stocks?
Earnings reports could lead to significant shifts. Tech stocks are likely to drive the volatility, creating both risks and opportunities.
To conclude, what should traders take away from this analysis?
This week is packed with opportunities but also challenges. Staying informed and adaptable is key to navigating this volatile environment successfully.
And finally, what's the critical focus for traders this week?
Traders must watch economic signals closely, as these will guide their strategies. Always be prepared for rapid changes.
Welcome to Mott Capital's Market Chronicles. Today, we're diving into a pivotal week for the financial markets, packed with volatility and significant economic announcements.
That's right. Insights from our very own Mike will guide us through the whirlwind of earnings reports and meetings that can shift market dynamics significantly.
So, what's the main thesis of this week's discussion?
The core idea is that this week's economic data, especially the job report, will likely dictate the direction of the markets, including the behavior of the yield curve and equities.
What are the key milestones we should be watching for?
We have the job report due on Friday and a Fed meeting. These events can shake up the markets.
And what's the scoop on the job report?
The job openings are trending down, with forecasts showing unemployment at 4.1%, a sign of a cooling job market.
What about that all-important yield curve?
If the yield curve steepens, it could signal trouble for the equities market, reflecting economic distress.
How might the markets react to this data?
Market sentiment could pivot on the job report, influencing major tech stocks and the direction the Fed takes on rates.
What other global factors are at play this week?
The BOJ meeting could impact currency expectations significantly, particularly given the recent volatility in the yen.
What predictions are being made regarding the job market?
If unemployment exceeds 4.1%, we might see a more cautious market approach moving forward.
And what about recession indicators?
Higher unemployment rates historically signal recession, especially if they coincide with continued yield curve steepening.
To wrap things up, what are the key takeaways?
The job report and Fed meeting are pivotal. Investors should brace for potential market shifts based on these economic indicators.
Any final thoughts?
Keep an eye on those job numbers and yield curve movements. They could shift market sentiment in significant ways.
Welcome to the David Lynn channel. Today, we're diving into a topic that's both alarming and crucial: the declining fertility rates threatening our economy and humanity's future. Joining us is the insightful Melissa Kearney, an expert in this field.
Absolutely. Melissa is not just a guest. She's a powerhouse in economics, having testified before Congress and authored key works on income inequality. Ready to unravel the truth behind dwindling birth rates? Let's get started.
So what's the crux of the matter? Why should we care about declining fertility rates?
The main thesis is chilling. The continued decline in fertility rates will lead to a shrinking population and workforce, which could severely hamper economic growth and innovation if no interventions are made.
Let's highlight some critical points. First off, Melissa mentions that the U.S. fertility rate is below replacement level, meaning the population isn't replenishing itself.
Exactly. That means the typical woman in the U.S. is expected to have fewer than 2 kids over her lifetime, a real recipe for a shrinking population.
Now on to the economic side. What happens if we ignore this trend?
An aging population and shrinking workforce mean less economic growth. Without enough young people, we risk fewer innovations and lower productivity.
Interesting. What about the cultural aspects at play here?
As priorities shift, fewer individuals are choosing parenthood. Financial burdens and career ambitions are steering people away from having children.
And this isn't just a U.S. problem, right?
Not at all. Declining fertility is a global issue with similar trends seen in many developed nations, creating a universal challenge.
What does the future look like if these trends continue?
If birth rates keep falling without government intervention, we may face an increasingly aging society, raising questions about the sustainability of our economic structures.
What can be done to address these issues?
We need to establish pro-family policies, invest in childcare, and make parental leave more accessible to encourage childbearing among working individuals.
To wrap things up, what's the key takeaway?
Immediate action is crucial. Addressing declining fertility rates is essential for both our economy's longevity and the future of society as a whole. Let's encourage discussions and positive changes.
What lasting impact should we aim for?
Investing in our families and future generations leads to happier lives and a more stable economy. A balanced approach is necessary for everyone.
To wrap things up, experts across the board emphasize the alarming state of the economy.
From Hanke warning about the Fed's losses to Snyder's outlook on recession, there's a collective urgency to understand these economic shifts.
As we noted, the housing market is also undergoing troubling trends, suggesting that vigilance is crucial. Thanks for watching Financial Insights in Minutes for July 28th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.